Welcome to the Deep Dive. Today, we're taking a deep, concentrated look at the Q3 2025 financial results for RadNet, ticker RDNT.
Yeah.
They are a massive player in outpatient diagnostic imaging and increasingly in digital health. This earnings call really provided a clear blueprint for where this is all heading.
And that blueprint, you could see it resonate almost immediately with the street. I mean, if you were watching the charts, you saw the stock showed significant strength,
Right.
which tells you investors weren't just checking boxes. They found a compelling narrative here. The core tension is how management is pulling off record growth while also making these big strategic bets on R&D.
And that's our mission today. You, the listener, need to understand the metrics, the shift toward AI-enabled capacity, and what management is signaling just before their big investor day.
So let's get into it. The results snapshot. It was a tale of two sheets, really.
Absolutely. The headline financials were, a bit mixed, but the market clearly picked what it wanted to focus on. Revenue landed at $522.9 million.
Which just blew past consensus expectations. That's a powerful 13.4% year-over-year increase. You just can't ignore that kind of top-line momentum.
And that strength carried through to the operating metrics, too.
It did. Adjusted EBITDA was very robust at $84.9 million, a 15.2% year-over-year jump. That's the core operational health right there. Margins even expanded a bit, up 26 basis points.
Okay, so where was let's call it the friction? The GAAP EPS was pretty modest, 0.07 cents, and the non-GAAP number, $0.20, actually missed consensus by little.
Right.
For a company with record revenue, that needs some context. What was holding back the bottom line?
And this is where you see the strategy. Management was extremely candid that this miss was almost entirely intentional.
Intentional.
Yes, it's tied to these significant non-capitalized R&D investments. We're talking $18 to $20 million for the full year, all for their deep health, cloud OS, and generative AI work.
So they are actively choosing to spend, 3 to 5 cents per share right now, instead of booking it as profit to buy future efficiency.
Precisely. They are funding a fundamental transition. If you're a long-term investor, you look at that and you say, okay, they're sacrificing pennies now to unlock dollars later.
And the market seems to have agreed.
The market definitely agreed. And you also had some discrete one-time items in there, like transaction costs, severance, that sort of thing.
I want to clarify something they mentioned, de novo leases. For someone not in this space, what does that actually mean?
Good question. De novo just means from new. It's all the upfront costs of opening a brand new imaging center.
So signing the lease, fitting out the space.
Exactly. All those costs you have before you stand your first patient, they hit the P&L short term, but it's how you grow your footprint.
Which is a perfect setup for the underlying performance, because that spending is what's supporting this incredible volume they're seeing. Let's dig into that core imaging business.
The numbers here are just, they're really impressive. The strength wasn't just in the total number of exams, it was in the type of exams. Advanced imaging volumes grew 13.0%.
And the same center volume number.
Robust, really robust, 9.9%.
That same center growth is the gold standard, isn't it? It shows they're getting more out of the assets they already own.
Absolutely. And when you look at the specifics, MRI volumes grew almost 15%, and PTCT just accelerated, up over 21%.
And that's where the real margin is.
That's where it is. That mix shift is structurally improving their profitability. Advanced imaging is now over 28% of their total procedure mix.
Okay, but this kind of growth, you can't just run the machines longer. What levers are they actually pulling to handle this much throughput?
It's sort of a three-pronged approach. First, you have equipment and software upgrades that are literally shortening scan times.
So you shave a few minutes off an MRI, and over a full day, that adds up to another slot or two.
Exactly. Second is just adding net capacity through those new de novo centers they're opening, 5 so far this year.
And the third prong, this feels like the most important one, is technology to get around the biggest problem in healthcare right now, labor.
That's it. They're using AI-enabled remote scanning. Historically, if a skilled technician calls out sick, you lose the use of a multi-million-dollar machine for the whole day.
A huge waste of capital.
A huge waste. With their TechLive system, a skilled tech can monitor and manage scans across multiple sites from a remote location. It keeps the machines running.
That's a powerful fix. And speaking of powerful fixes, let's talk about reimbursement. Historically, that has just meant one thing: constant Medicare cuts.
This is a monumental piece of news. For a company where Medicare is almost a quarter of their business, this is huge. For 5 years, they have just been absorbing cuts.
Right. They've had to run twice as fast just to stay in place.
Precisely. Which is why this Q3 update was so critical. Right. They're reporting a positive outlook for 2026 Medicare reimbursement.
Not flat, but positive.
Positive. Based on the final rule, they expect a revenue uplift of about $4 to $5 million next year. It's a complete reversal of a 5-year trend.
A huge structural tailwind. Okay, let's switch gears to digital health, because this is the innovation story that got investors excited. Revenue up over 50%, AI revenue up over 100%.
And a lot of that acceleration was fueled by the iCAD acquisition they closed in July. That asset started contributing revenue right away, and the integration is apparently ahead of schedule.
Let's focus on the flagship product, EBCD. That's their AI-powered breast cancer screening. Patient adoption is one thing, but the real key is payer adoption. What's the breakthrough?
The breakthrough is moving from patient pay to payer covered. Several really large capitated medical groups, we're talking big names like Regal, Lakeside, they've all agreed to cover EBCD as a benefit for over 700,000 of their members.
So why are these, very cost-conscious groups agreeing to pay for a new AI tool?
It comes down to two things. Early detection, which obviously lowers long-term treatment costs, and, maybe more importantly, HEDIS performance.
HEDIS being the quality measurement standard for the industry.
Right. HEDIS measures compliance with things like annual mammograms. If a group's members skip their screenings, their score drops, and they lose out on big quality bonuses from Medicare.
So by covering EBCD, they remove a cost barrier, more people get screened, the ED score goes up, and they get their bonus money.
It's a perfect win-win. It's tied directly to value-based care.
A fascinating way to drive AI adoption. Now, how is AI tackling the operational side? You mentioned dynamic scheduling earlier.
This is where they start acting less like a clinic and more like an airline.
Okay.
They're using predictive models to identify exam slots where patients are statistically likely to be a no-show. This lets the system intelligently overbook those slots so they don't go to waste.
Just like selling that last middle seat on a plane.
That's the concept. It's pure yield optimization, making sure that expensive machine and that skilled tech are never idle.
That sounds great. But what's the risk? I mean, anytime you're integrating AI and patient data, you're introducing complexity.
They did address that. They emphasized that their R&D spend on that Deep Health Cloud OS is what makes this possible securely. They see it as this protected layer that lets these tools run safely.
And they doubled down on the labor problem with another acquisition.
They did. On November 5th, they acquired the assets of Alpha RT. This wasn't just about tech, it was about multiplying their labor force. Alpha RT expands the remote scanning to be vendor agnostic.
Meaning one tech can run a GE scanner in one city and a Siemens scanner in another.
From the same chair. It's a system for managing highly specialized labor with incredible efficiency. It also lets them use less specialized staff on site to handle patient interaction while the expert focuses on the scan. It completely changes the labor model.
Which makes the CMO deployment even more interesting. Tell us about that.
So they rolled out CMO's thyroid ultrasound AI across more than 240 centers. This tool is cutting the scan time for these ultrasounds by over 30%.
30%, that's just found capacity.
It's pure capacity creation. It allows them to slot in way more patients during the day. And there's already a reimbursement code for this kind of computer-assisted detection, which helps with adoption.
Okay, let's pull all this together. The volume is great. AI is solving the labor problem, and they've neutralized the Medicare headwind. No wonder they raised guidance.
For the third straight time, yes. Imaging center revenue is now guided up to the $1.90 to $1.93 billion range, and adjusted EBITDA lifted to $276 to $284 million.
And the balance sheet gives them tremendous flexibility to keep going. They have over $800 million in cash.
With a very conservative leverage profile, we're talking a net debt to EBITDA ratio of about 1.0x. That's a powerful platform. It tells investors they have the firepower to execute.
Let's circle back to that phenomenal PTCT growth. What specific markets are driving that 21% number?
Management was very clear on this. They said 20% of their PTCT volume is now coming from two high-growth areas, PSMA, prostate imaging, and amyloid brain studies for Alzheimer's.
And they see that as just the beginning.
Totally underutilized in their view. And they're positioning for huge future growth, which is tied directly to the regulatory pipeline, correct?
Correct. They are getting ready for new radioactive tracers expected in the coming years, which will dramatically expand what you can do with a TTCT scanner, especially in oncology and neurology.
So they need to have the physical capacity ready to go when those new tools hit the market.
So what's the next big thing the market is watching for?
The immediate catalyst is their Investor Day, which is tomorrow, November 11th. Management said they're going to lay out the full AI roadmap and, critically, unveil their 3-year plan through 2028.
That's where they'll really solidify this story about becoming a software-driven platform.
Exactly. Not just a collection of centers.
All right. It is time for our investment committee pitch. And a reminder to you, the listener, we are not financial advisors. This is not financial advice. This is just an outrageous but plausible trade idea.
I'm pitching a long RDNT trade. And it's all about leveraging that colossal cash balance, that $804.7 million, and their focus on high-growth imaging.
Okay, lay it out. What's the aggressive move you're betting on?
The bet is that management sees these tailwinds, the Medicare reversal, the new tracer pipeline, and decides to just hit the accelerator hard.
Meaning
Meaning they immediately fund a massive accelerated equipment rotation and expansion program focused exclusively on high-field MRI and PET/CT. Not just small tuck-in M&A, but a huge internal CapEx blitz.
So front-loading a ton of capital.
Yeah.
The risk is execution, but the payoff is locking up market share.
Exactly. They have to own the capacity when those new tracers land in 2026. They have the balance sheet to do it. They could throw an extra $100 million at CapEx to build new centers and upgrade equipment faster than anyone.
It'd push their leverage up a bit.
It would, slightly, but it would rapidly increase future EBITDA well beyond what anyone is currently guiding to. It's a bet on them using their financial strength to play offense aggressively.
A compelling pitch, turning that strong balance sheet into outsized future growth. So to wrap this all up, RadNet delivered record top-line performance, really fueled by advanced imaging. And they did it while making these key AI investments that are fixing labor problems and opening up new revenue streams. All of that is what fueled the guidance raise and that bullish reaction we saw.
And my final thought for you to chew on is this. The RadNet story is a clear signal of how technology is fundamentally restructuring healthcare, labor, and economics. The core question for any other provider watching this is, how quickly can you transform from being just a hardware-dependent center stuck with local labor problems into a scalable, software-driven platform? That transition is what will define the winners and losers for the next decade.
Absolutely. The Deep Doc, thank you for joining us for this in-depth analysis of RadNet's Q3 2025 results. We'll catch you next time.